Welcome to my channel. I'm Scott, and in this video I am going to walk you through the process of valuing GameStop stock by analyzing their financial statements and dissecting their financial ratios so we can determine if it's a buy or a sell. GameStop is a video game, consumer electronics, and gaming merchandise retailer. The company is headquartered in Grapevine, Texas, and was founded in 1984. It started trading in 2002 and can be found on the New York Stock Exchange, Mexican Bolsa, and Deutsche Börse. It is the largest video game retailer in the world. It has 4,800 stores, including 3,200 in the US, 250 in Canada, 420 in Australia, and 950 in Europe, all under the GameStop, EB Games, ThinkGeek, and Micromania Zing brands. In addition to retail stores, it owns and publishes Game Informer, a video game magazine. It started out being called Babbage's, but changed its name to GameStop in '99. I remember shopping at Babbage's as a kid. Ross Perot was an early investor in the company. He ran for president and received the most votes for a candidate not attached to a major party, like the Democrats or Republicans. The company's performance declined during the mid to late 2010s due to the shift of video game sales to online shopping and downloads. Also due to the failed investments by GameStop in smartphone retail. This year, the company's stock price skyrocketed due to a short squeeze orchestrated by users of the internet forum Wall Street Bets. The company received significant media attention during January and February due to the volatility of its stock. This all started when hedge funds saw GameStop as the next failed retailer. In order to benefit from their demise, you need to sell the stock and then buy it back when the price falls. You are selling high, then buying low. You may be asking, how can you sell the stock if you do not own it? Your broker allows you to borrow the shares from someone for a small fee, but you must return the shares at some point in the future. This is what we call short selling. If you shorted GameStop in the summer of 2020 when it was trading at $4 a share and the stock dropped to $1 a share, you would have made $3 each share you shorted. At one point, the short interest on GME was above 100%, meaning some shares were borrowed more than once. In theory, a share can be borrowed and sold an infinite number of times. The problem is that instead of GME stock price going down, it went up. If you borrowed 1 million shares and sold them in the open market for $4, you now have $4 million in your brokerage account. But if the stock price is at $10, you need to either 1, add cash to your account as collateral to meet the margin requirement, or 2, you can buy the shares in the open market for $10 million and close your short position. You would have to accept a $6 million loss. What if you do not have any more money? This trade may have bankrupted you. What if you're on the opposite side of things where your shares were borrowed by your broker to be shorted by a hedge fund? Don't worry, because your broker's job is to replace your shares, even if the hedge fund cannot. In addition to retail investors buying up this stock, another reason this stock shot up so much is because some short sellers bought the stock back to cover their short position, which drove the stock price higher. Because when the demand for a stock is higher than the supply of the stock, the price goes up. Some short sellers did not want to buy the stock at $50 a share, so they waited for it to go down. But instead, it went to $100 per share. So all these hedge funds got really nervous, and some cut their losses and bought the shares to cover their position, pushing the price higher. Some short sellers did not want to buy the stock at $100 a share, so they waited for it to go down, but instead it went to $200. So all these hedge funds got really nervous, and some cut their losses and bought the shares to cover their position, pushing the stock price higher. Some short sellers did not want to buy the stock at $200 a share, so they waited for it to go down, but instead it went to $300. So these hedge funds got really nervous, and some cut their losses and bought the shares to cover their position, pushing the price higher. There is no limit on how high the stock price can go. This whole process is what we call a short squeeze. The irony is the stock market as a whole was down because hedge funds had to sell billions of dollars of stock in other companies like Apple, Facebook, Tesla, Kraft Heinz, etc., because they were forced by their broker to cover their short positions, else file bankruptcy, which some hedge funds did. Let's get started with the model. This is a large cap company, 12 billion market cap. They're trading at $167 a share, and they have 74 million shares outstanding. Let's look at the financials. The way you value a company is you estimate the free cash flows into the future and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. So you can see they have positive free cash flow every year except in 2020. Net income is the profit or loss on the income statement. It's revenue minus expenses, and that's negative every year. Revenue is a sales for the company, and that goes down a lot from 8.3 billion to 5.3 billion. This is the company's income statement. The top line is the revenue, the sales. Below that is the cost of revenue. These are the expenses directly related to generating the revenue. A big cost of revenue for this company is the cost of their employees at their retail stores. Revenue minus cost of revenue gives you your gross profit, and that's been declining from 2.3 billion to 1.3 billion. Then below that is operating income. They did have positive operating income in 2019, negative after that. They paid 51 million of interest on their debt, which was a little lower than 2019. And the bottom line of the income statement is their net income, which is negative every year. And the only reason it's negative in 2019, they had a $1 billion asset impairment. An asset impairment is when you decrease the value of an asset on your balance sheet and then pass through the loss onto your income statement. This is a non-cash item, as I'll show you on a statement of cash flows in a little bit. This is the company's statement of cash flows. The top line is operating cash flow. That's how much cash the company loses or generates from its operational business. So you can see they did generate positive operating cash flow most years. And the reason they had negative in 2020 was because they had to pay $800 million in accounts payable. Accounts payable is when you buy a product on credit and you pay for that product in the future. And then you have capital expenditures, which are investments in property, plant, and equipment. Operating cash flow minus CapEx gives you your free cash flow. So they do have positive free cash flow every year except 2020. So their financials don't look that bad so far. And a really smart move of the company was to issue stock when the stock price got inflated. They issued over $500 million of stock, and they used that cash to pay down debt. So that's like a $1 billion swing. They received $500 million of cash from selling stock, and they used that cash to reduce their debt. So now they have to pay less cash in the future because they don't have to pay the interest payment on the debt they paid off. This is the equity section of their balance sheet, and they have nearly $900 million of equity. They raised over $500 million from issuing capital stock since they IPO'd, and they have $400 million of retained earnings. That's a sum of all their prior net incomes. So the company historically has been profitable. I know a lot of people say in the past they were profitable, but that's because their business model worked. But going forward, their business model is flawed. I'm not sure that's totally the case. Companies can pivot and change things up, and I think that's what they're doing. Let's look at their capital structure. 880 million of equity, 700 million of debt. So they're 55% equity, 45% debt. And they could pay down pretty much all the debt with the cash on their balance sheet. So in a sense, they're debt-free. Their weighted average cost of capital is 7.88%, and that's a discount rate we're going to apply to the future cash flows. We estimated 4 years of future free cash flows. We also estimated the terminal value, which is all cash flows past year 4. That's 1.9 billion. We discounted those numbers back to today using the weighted average cost of capital. We get a value of the company of $1.7 billion. We divide that by 74 million shares. And we get a calculated stock price of $23. They're trading at 167, so they're trading at a 600% premium. It's a sell according to the model. The way I estimated their future free cash flows, I took the median of their prior free cash flows. The median is the middle number. Since there are 4 numbers we're looking at, to get the median, you just take the middle 2 numbers and get the average. So we could eliminate the lowest number and eliminate the highest number. So the average of these 2 numbers is 75 million. Then I grew their free cash flows 10% each year until 2025, and then grew it 2.5% to perpetuity, which I do feel is a reasonable estimate for this company. Simply Wall Street values the company at $19. They're also saying it's overvalued. 5 analysts priced this stock, and the average was $88. The low was $25, the high was $190. This is where the stock has been trading since it IPO'd in 2002. You can see the stock price never got that high until the short squeeze a few months ago, and then it broke $300 a share. But it's hard to tell on this chart. Let's look at the 1-year chart. This is where the stock has been trading the last 12 months. So this is when the short squeeze occurred and the stock price was driven up. And then it came pretty much all the way back down to where it was trading before the squeeze. And then surprising me, and probably surprising a lot of people, it came back up. Not to where it was before, but it came up pretty high. And it's almost stayed that way, which is amazing because usually when there's a stock squeeze, or anytime a stock goes up really quickly, it usually comes down a lot and doesn't go back up for a while. But this came right back up. So maybe this company has a better future than a lot of people thought. Since their stock is so volatile, they have a negative beta. The stock went up 40x in the past 52 weeks, much better than S&P 500. It was below $4 a share before the squeeze. It got close to $500. It's currently trading above its 200-day but below its 50-day moving average. 6.7 million shares have been traded on average each day the past 3 months. Of the 74 million shares outstanding, 56 million are on float, 41% are held by institutions, and it still has a pretty high short percentage. 18.5% of the shares on float are shorted. And this stock is up a lot the past year, past 3 years, and past 5 years, much more than its industry and the market. Analysts are forecasting their earnings to grow over 100%, but their revenue to be flat. That seems kind of odd to me. In the past 5 years, their annual earnings decreased 50%, but in the past year, their earnings increased 82%. It went from a big negative to a moderate negative. If you invested $10,000 in this company 10 years ago and you held on, the value of your stock would have been close to $200,000 at one point, but it'd be $100,000 today. That's still a great return on investment, 27% annual return. The biggest shareholder is BlackRock at 12.3%. Then Ryan Cohen is the second biggest shareholder. His value is $1.5 billion. He was the co-founder and ex-CEO of Chewy. He's now chairman of the board, and he's been shaking up their board and the company's management. So with his guidance, I'm really optimistic on their future. Before he got involved, I wasn't as optimistic about the company. George Sherman, who just got replaced as CEO, owns 1.7% of the company's stock. Matt Furlong recently took his seat. Let's look at their financial ratios. We can't look at the PE because they have negative net income. Surprisingly, their price to sales ratio is pretty good at 2.3. Even with an inflated stock price, they still have a good amount of revenue relative to their market cap. That's better than the market median and average. Their price to book ratio isn't so great at 14. They do have a good current ratio. They have 1.7 billion of current assets and 1.2 billion of current liabilities. Their quick ratio is below 1. The way you calculate the quick ratio is you strip out the inventory from current assets. And they do have a good amount of cash on their balance sheet, $700 million. That's from the recent capital raise. They are well funded. They had $86 million of free cash flow in the trailing 12 months and over $400 million of working capital. So they have over $500 million of funding. The best way to look at ratios is to compare them to companies in the same industry. I've done videos of 11 companies in the same industry as GME. And if GME has a number in red, they're worse than the average. If they have a number in blue, they're better than the average. Their price to sales ratio is worse than average, but it's still a decent price to sales ratio. Their price to book, even though it's not so great, is a little better than average. Current ratio is about average. They have a bad ROE. They are lower in debt than average, mainly because they got rid of that $500 million of debt recently. And they are bigger than the average company, 12.4 billion market cap. Average is 7.6 billion. And they don't pay a dividend. The last time they paid a dividend was in March 2019. So to summarize, I have them trading at a significant premium, mainly because their stock price has been so inflated. But I wouldn't be surprised if this company grew to $10 billion in revenue in a few years. With the company's new leadership, I think they have potential to be bigger than they ever were. Of course, I do know a lot of people aren't buying this stock on their fundamentals. They're looking for a quick buck to go in and out. So I definitely wouldn't buy the stock at this price. If I did buy the stock, I would definitely need it to come down a lot, at least below $50 a share. But who knows, it may never come down that far. I'm shocked the stock price stayed up so high for so long. Pretty much all the other short squeezes came back down. I know AMC had another short squeeze recently, but let's see where it is in a couple of months. I ranked their free cash flows 3 out of 10, their revenue 4 out of 10, and their ratios 3 out of 10. So let me know what you think. Give this video a like, subscribe, or comment below. Also, if you'd like to get a custom valuation or just support the channel, you can become a member by clicking on the link in the description below. Thanks for watching.